A lot of us approach investing as though it is a single decision we make once, usually when we first sit down to set up a portfolio. We ask ourselves, what is my risk tolerance? From there, we decide our allocation. How much goes into stocks? Do we want bonds? And if so, how much? We pick a mix, set it up, and move on. But here is the problem with that entire framing. Your portfolio is not a personality test you take once and file away. It is a tool. And like any tool, its job changes as your life changes. A portfolio designed for a 25-year-old serves a completely different purpose than one designed for a 45-year-old, or someone stepping into retirement, or someone in their late 70s navigating an entirely different set of priorities. And that is precisely why so many investors feel confused and uncertain. They are applying the exact same portfolio logic at every stage of life, wondering why it no longer seems to fit. Hey everyone, I am Erin. Welcome back to the channel. Today I want to walk through a clear, data-backed life cycle trend in portfolio construction. And I want to be upfront about something before we get into it. These are not rules. These are not rigid prescriptions. What I am sharing is a pattern, the way a portfolio tends to naturally evolve across the course of an investor's lifetime, as supported by decades of data. This will be useful whether you are just starting out in your 20s, navigating the complexity of midlife, approaching retirement, or already in retirement, and wondering whether your current portfolio still makes sense for where you are today. Here is the central organizing principle behind everything we are going to cover. Portfolio construction evolves because the job of the portfolio changes over time. Across decades of research and real-world investor behavior, the same pattern emerges again and again. Early in life, the goal is to grow your human capital, meaning you, your skills, your earning potential. In midlife, the goal shifts to protecting the plan from bad timing. Once you reach retirement, the objective becomes funding your spending while preserving flexibility. And in later retirement, it becomes about managing longevity, inflation, and something that does not get nearly enough attention: simplicity. Notice something important here. We are not simply saying a portfolio should become more and more conservative with each passing decade. In fact, as we work through each phase, you will see that is generally not the full picture across an entire lifetime. What we are really talking about is managing the specific type of risk that matters most at each particular stage. Phase 1, your 20s to early 30s. Growth is the job. The primary risk at this stage is not owning enough growth. The primary asset is your future earning power, your human capital. The data at this phase of life is remarkably consistent. Most long-term wealth is ultimately created in later decades, but it is made possible by the choices and habits established early. Time is the most powerful force in investing, and you have more of it at 25 than you ever will again. That is why portfolios at this stage are most effective when they are heavily growth-oriented. General tendencies you will often see: approximately 80% to 100% allocated to stocks, with bonds playing a minimal role, if any at all. Here is the underlying logic. Your paycheck is your bond at this stage. Your income is stable, consistent, and hopefully growing year over year. That financial foundation allows you to take on significantly more risk with your investment portfolio. And here is something worth genuinely internalizing. At this point in your journey, the fact that you are investing at all matters more than the exact amount. And it matters far more than trying to time the market perfectly or chase the highest possible return. What you have on your side is time, and time is your greatest financial advantage. Market volatility at this stage simply does not carry the same threat it does later. Markets will fall, headlines will feel frightening, but what matters most is that you keep investing through it, because once you zoom out and see your investing career spanning 30, 40, or even 50 years, those early downturns become barely a blip on the long-term chart. They are the seed, however, the foundation from which everything else eventually grows. One more critical point here. At this stage, you are not withdrawing from your portfolio. You are living off your income and allowing your investments to compound untouched. A market crash in your 20s is a headline, not a threat to your financial security. But, and this part matters enormously, this approach only works if your behavior holds up. An aggressive portfolio that you abandon during a scary market is far worse than a moderate portfolio you can consistently stay committed to. Which brings us to an important distinction: the difference between risk tolerance and risk capacity. Risk tolerance is emotional. How much volatility can you personally handle without panicking, second-guessing, or making reactive decisions? Risk capacity is mathematical. How much risk can your actual financial situation absorb based on your income, your time horizon, and the flexibility you have to recover? Your portfolio has to fit both dimensions, because the best portfolio that exists on paper is completely worthless if you cannot hold on to it when markets get difficult. Now think about this for a moment, and it really does explain why taking significant risk early makes complete sense, without ever needing to debate stocks versus bonds. For most people at the beginning of their careers, financial wealth is minimal, but something else is incredibly large at that same moment: human capital. The present value of all the income you will earn over your working lifetime. That earning power is your dominant asset in your 20s and 30s. It is what allows you to invest consistently, absorb market downturns without being financially devastated, and rebuild over time. As the years pass, that earning power gradually declines. How quickly depends on your career trajectory, your health, and your personal circumstances. But if you have been investing consistently along the way, something important is happening simultaneously. Your financial capital is growing, and over time, that financial capital takes over from your labor as the primary engine supporting your life. Early on, human capital dominates and financial capital is small. Eventually, that relationship flips, and it is that flip that changes everything about how you should be managing your portfolio. When human capital is high and financial capital is low, market volatility has very limited impact on your long-term outcome. You are not spending from the portfolio. You are living off your paycheck. Time is on your side. The single biggest risk at this point is not short-term volatility. It is missing out on decades of long-term growth by being too cautious. Phase 2, mid-30s through 40s, growth plus stability. The primary risk here shifts to overexposure to volatility as real wealth begins to accumulate. The primary asset is a growing investment portfolio, still supported by human capital, but no longer dominated by it. This is where the story starts to change. Your portfolio is likely meaningfully larger than it was a decade ago. It is carrying considerably more weight, and your life has probably become more complex. Mortgages, children, career responsibilities that create both financial and emotional stakes you did not have before. You are still very much in a growth phase, but the consequences of volatility are different now. General tendencies at this stage: portfolios remain equity-heavy, typically around 70% to 85% in stocks, but bonds begin to take on a genuine structural role. They are no longer just a placeholder. They actively work to smooth out the ride. Here is what changes as your portfolio grows. Dollar-denominated losses get larger even when the percentage is identical. A 20% decline on $50,000 feels very different from a 20% decline on $500,000. Life events, children, mortgages, potential career shifts reduce your overall financial flexibility, and recovery time begins to matter in a way it simply did not in your 20s. This is often the first phase where investors start to recognize something important. It is not about capturing the absolute highest return at all times anymore. It is about building something durable, something that can stay in place even when life gets complicated and markets get messy. There is also a behavioral dimension that becomes critical here. This is the phase where behavioral risk can start to rival or even exceed market risk as the primary threat to your plan. Selling at the wrong moment can cause real, lasting damage. And overconfidence, the flip side of fear, is just as destructive. Making a poor decision during a difficult market period is far more damaging at this stage than it was a decade earlier. This is where many investors naturally gravitate toward what is commonly called a balanced portfolio, typically somewhere in the range of 50% to 70% stocks and 30% to 50% bonds. The goal is to smooth out the volatility without surrendering the long-term growth engine. For a lot of people, this represents an emotional sweet spot. Enough growth potential to keep the plan on track. Enough stability to keep you from making reactive decisions you will later regret. Balanced portfolios are most common among mid-career investors who have real responsibilities, value their peace of mind, and still have long time horizons ahead of them. At this stage, the best portfolio is the one that keeps you from making a single decision that permanently derails the entire plan. Phase 3. Your 50s, the danger zone most people misunderstand. The primary risk here is sequence of returns risk. The primary asset is accumulated financial capital that is now approaching active deployment, not just continuing to grow. This is one of the most consequential and consistently misunderstood phases of an investor's journey. The data is very clear. Poor returns in the years immediately before or just after retirement can permanently alter long-term outcomes, even if the long-run average returns look perfectly fine in hindsight. This period is often called the danger zone for good reason. General tendencies at this stage: a gradual shift toward 50% to 65% equities. Cash and bonds take on a timing function now, not just a stabilizing one. And the portfolio begins being shaped around the reality of upcoming spending needs, not purely future growth. The critical question this phase demands is, can this portfolio survive bad timing without forcing bad decisions? We are not abandoning equities here. Equities remain essential. They are what carries you to and through retirement, but retirement is now visible on the horizon, and that visibility changes the way risk behaves in your portfolio. You are no longer investing with the abstract idea that someday you will use this money. You are now investing with a specific landing date in mind. You want a portfolio that can absorb a difficult market, preserve your options, and allow you to stay the course even if conditions are imperfect. Your 50s are fundamentally about preparation. Preparation for unexpected timing, unexpected volatility, and ensuring your plan holds together in the real world, not just in a spreadsheet. One important clarification worth emphasizing: we do not want to de-risk too aggressively or too soon. The goal is not to tiptoe timidly into retirement. The goal is to arrive at retirement strong. We still need equity exposure for growth. We still need it to protect purchasing power over time. What we are doing in this phase is reshaping risk, not eliminating it, so that bad timing does not derail everything you have built. Phase 4. Early retirement, your 60s to early 70s. Income first, but growth still matters. The primary risk at this stage is being forced into bad decisions at the wrong moment. The secondary risk is inflation quietly eroding your purchasing power. The primary asset is your accumulated portfolio, which is now actively funding your lifestyle rather than simply building in the background. In early retirement, your portfolio is carrying two jobs simultaneously, funding your current spending and preserving future flexibility. And this is where the role of each asset class really comes into sharp focus. General tendencies at this stage: balanced portfolios typically in the range of 40% to 60% equities, a clearly defined income floor, Social Security, a pension, reliable bond income, and stocks that are no longer funding today's lifestyle, but are instead protecting against the longer-term risk of outliving your money. Research from Morningstar and from Michael Kitces consistently shows that entering retirement with stocks as a minority share of your overall portfolio can meaningfully improve long-term retirement outcomes. Why? because that balance improves your ability to absorb market shocks, reduces the likelihood of being forced to sell equities at exactly the wrong moment, and materially lowers the probability of long-term portfolio failure. The mindset shift here is significant. Stocks become about future spending power. Bonds and cash become about decision-making freedom. They buy you time and options. They allow you to wait out a difficult market without being forced into a reaction. Early retirement is fundamentally about building the right structure, a structure that minimizes potential regret. At this stage, the biggest threat is not underperforming the market. It is being forced into poor decisions when conditions are unfavorable. As retirement progresses, many investors gradually move toward what is often called an income-oriented portfolio, typically somewhere around 20% to 40% in stocks and 60% to 80% in bonds and cash equivalent assets. The objective is stability, reliability, lower volatility, smaller drawdowns, and dependable near-term spending support. But income-oriented does not mean growth-free. The equity portion of the portfolio, though smaller, is still performing a vital function. It is simply playing a supporting role rather than the starring one. Phase 5. Late retirement. Your 70s, 80s, and beyond. Simplicity and longevity. The primary risk here is outliving your money. The secondary risk, and one that is underappreciated, is cognitive and administrative complexity. The primary asset is a mature retirement portfolio supported by locked-in income sources that provide a reliable floor. This is the stage where portfolio construction shifts again, and the data consistently surprises people when they see it. Even in your 70s and 80s, time horizons can still be meaningful. A healthy 75-year-old may still have 15 to 20 years ahead. Inflation does not stop affecting your purchasing power simply because you have reached a certain age, and simplicity itself becomes a genuine form of risk management. Once you move past the early danger zone of retirement, something important tends to happen. Income floors are more secure and locked in. Spending gradually declines. And over time, retirees become progressively less reliant on their portfolio for day-to-day expenses. General tendencies at this stage, equity exposure often stabilizes, and in many cases, it actually increases slightly compared to the early retirement phase. Portfolios become leaner and simpler, fewer moving parts, systems that are designed to run largely on their own without requiring constant oversight or active management. Here is the counterintuitive truth that most people do not expect. Many retirees actually need more growth late in life, not less. Because longevity risk does not disappear, the portfolio still needs to last. And when you are less reliant on daily withdrawals and further from the early danger zone, you can generally afford to carry more equity exposure without it threatening your financial security. The goal at this stage is a portfolio that does not demand your constant attention. Easy to manage, straightforward to understand, and built to endure. Now let us take a step back and look at the complete arc of this journey, because the underlying logic becomes even clearer when you see it as a whole. Early in life, volatility is largely harmless. You have time on your side, income coming in, and the flexibility to recover from anything the market throws at you. In midlife, bad timing starts to carry real weight. Dollar losses are larger and recovery windows are shorter, so they hurt more. In early retirement, being forced to sell at the wrong time becomes the true enemy. Having to liquidate investments during a market downturn can permanently alter your retirement trajectory in ways that are very difficult to recover from. And in later retirement, complexity itself becomes a form of risk, not just financially, but practically and cognitively. At every single stage, the type of risk that matters most changes, and a well-designed portfolio adapts to that shifting reality rather than staying frozen in place. Here are the 3 things I want you to carry away from everything we covered today. First, your portfolio should match the job it is doing right now, not the job it was doing 5 or 10 years ago. Markets themselves do not change, but the risk that matters most to you absolutely does as your life evolves. Second, the best portfolios are not the ones with the highest returns on paper. They are the ones that help you avoid making bad decisions when it genuinely matters most. A portfolio you can stay committed to through difficulty is always more valuable than a theoretically superior one you abandon when things get hard. Third, none of these phases represent hard and fast rules. They are ranges. They are a general guide shaped by patterns that have emerged across decades of real investor behavior and market data. There is no single best portfolio that works for everyone at every stage of life. What works is building a portfolio that fits your life, your income, your time horizon, your emotional makeup, and the specific job your money needs to do right now. What are your thoughts on evolving your portfolio as life changes? Have you actually adjusted your approach over the years? I would genuinely love to hear your perspective. Drop it in the comments below. New videos every single week. If this one gave you something useful, please give it a like. If you are new here, consider subscribing. And if you know someone who would benefit from thinking about their portfolio through this kind of lens, please share it with them. See you in the next one.